Next up in our due diligence process is evaluating the assets and liabilities of the company. We want to start by looking at the physical assets that they have. And these are going to include the property, equipment, inventory, and other tangible items. Some businesses don't have much or any tangible or physical assets, and that's okay, but we're going to cover it for those that do. And what we're going to do is we're going to evaluate the condition of the assets, inventory, and property. Okay, so why are we doing that? Well, for condition of the assets, you want to inspect the condition of any equipment, machinery, or property that the business owns, because you don't want to inherit outdated or malfunctioning equipment that requires costly repairs or replacement. If there are things that need to be repaired or replaced, or some sort of adjustment that's needed, you want to make sure you bake that into the price that you pay. For inventory, you want to ensure that the inventory levels are adequate to meet demand, but they're not excessive, as this could tie up your working capital negatively. You want to check also for obsolete or unsellable inventory that might be hidden in the deal. And then for property, if the business owns real estate, you want to have that appraised to determine its current market value. You want to verify ownership and ensure there are no liens or disputes regarding the property. Next, we want to review the receivables that the company has. And receivables are accounts receivable represent money owed to the business by customers. And you want to review the age of the receivables to assess their collectibility. And also how often customers are paying this business and how good customers are actually paying the invoices that are due. There's two things that you want to look at. The first is the aging report. And this is where you can check the accounts receivable aging report to see how long payments have been outstanding. Older receivables are definitely more challenging to collect, and some might not be collectible at all. And it's good to know that. Different agreements will say who keeps the accounts receivable. Sometimes it's the buyer, sometimes it's the seller. But if you are acquiring those, you want to know what's in here and how collectible that money is that you're counting and including and considering collectible. You also want to consider credit risk. You want to evaluate the creditworthiness of key customers to determine whether they are likely to pay in full and on time. And that's harder to do, but if you can do it, I would definitely recommend it. Next up, you're going to consider the outstanding debts the business has. You want to review all outstanding liabilities to ensure the business is not overburdened by debt or there's things that aren't on the balance sheet that you need to understand. There's two things that commonly come up: loans and credit lines and accounts payable. And for loans and credit lines, here you want to assess the terms of any credit lines that are available, what the interest rates are, repayment schedules, and penalties for early repayment. For accounts payable, you want to review the business's accounts payable to ensure no significant overdue payments are out there to suppliers and service providers that you will then be responsible for.